Today, we're going to give a recap of where interest rates are currently at. We're going to start with the 2 year rate and work our way all the way to the end of the curve. We're going to explain the yield curve inversion that's going on right now. Like, it's not so good. Not so good. I was like, but I want to discuss in this video where we're going to be at with the 30-year yield, the 10-year yield, and the 2 year yield. Let's dive in. So, what we're looking at right here is the 2 year, 10-year treasury yield. Let me move me. As of today, it was up 9.1%. That is one hell of a move for one day. That is that's noteworthy for sure. So we're looking here on the 1 month chart. We took out this pivot high from December of 2018. We've tried it 3 times. We tried it in June. We tried it in July, and it looks like we're breaking through in August. The next level of technical support that we have on the 2 year yield is all the way up here at 460. That'll be noteworthy. That's saying that the market thinks that Jerome Powell has a whole nother point and a half of interest rates left in him to go. That is not what the stock market is currently pricing in, guys. And if that would happen, that is going to cause the entire U.S. economy and possible world economy to go into a recession, if not maybe a depression, even though how crazy that sounds. Let's take a look at the 10-year yield. So the 10-year yield today went up 5.5% or 5.28%, which, if you are paying attention, you notice that the 2 year yield was 3.3, the 10-year yield 2.83, which means we have roughly 50 basis points of inversion between the twos and the tens, which is not a good sign for what the bond market is trying to say the outlook for the United States economy is. It's saying that the bond traders, think that real growth and inflation are slowing down out into the immediate term, 10 years out into the future, and that they think that the Fed is going to continue to raise rates like we just discussed. But when we're looking at the 10-year treasury yield right here, this is possibly one of the most important things that any investor should be looking at. Right? This is one of the most liquid, if not the most liquid and largest market in the world. Right? So even Warren Buffett would tell you, if he had to pick one thing that he could always look at, it would be the 10-year treasury. I would say it's the 10-year treasury and the DXY. All right, that shows you where the big money's at. If they're scared, if they're not scared, what they're thinking. So here on the 10-year, I'm more inclined to say we've tried this level from 2018, just like we did on the U.S. 2 year yield. We banged our head on it 4 times. Once in April, again in May, June, July, and in August. It looks like we're trying to hold. I'm not buying it. I think we might have a shot that we can retest up into the 3 level, but I think that's your immediate term, if not long term, cycle peak for the 10-year treasury note. I think you maybe can get back closer to 3 before we get our inflation number in the next couple of weeks. And once everybody sees that inflation is actually transitory and it's starting to roll over, transitory costs takes you 2.5 years to be transitory, but nonetheless, we'll move on from that. Good old politicians, baby. So let's take a look at the U.S. 10-year and 2 year spread. All right, so I have this on the 3 month chart here. This line right here is 0. So whenever we get below 0, that means that we're inverted. And usually, every time that in history that this chart has inverted, within the next 12 to 18 months, we've had a recession. So we're currently well below 0. We're at 50 basis points, 49.7 basis points inverted, which is damn near an all-time high or low, however you would like to look at it, amount of inversion in the yield curve. So right here in October of 2006, we were 28, 29 basis points inverted, and that led to everything we know, the GFC, which was just completely epic. If you listen to my man Jeff Snyder and Emil Kalinowski, they would say we're in a depression still, that we've never recovered. I was like, I don't know if I would go that far, but I tend to lean more into that camp than anything else. So let's look on this chart and see if we can find another place that we've been this inverted before. So in the dot-com bubble, the low of inversion was 48. So we're below that. Well, we have one here at 51. So you're saying there's a chance. We're not quite as inverted as we were in the dot-com bubble. But whenever you get to these levels of lows, I was like, this is not good. This is screaming, run for the hills, get cash, and just go hang out, sit on the beach for a little while. Well, with all that taken into account, I just want to give a recap of where I think the United States bond market is going to go. I think we have upside still on the U.S. 2-year Treasury in the immediate term. So I think you might can get a pullback, a 10% move in a day. You're more likely to give some of that back over the next week or so. But I think we have upside to 4.5% on the U.S. 2-year. I think you maybe can get the U.S. 10-year back roughly around 3%. Right, but I think you chop up, you get up there, and during CPI, that's going to come back down and continue to work its way sideways to down as the inflation trade kind of works itself out, and people start to price in the slower growth and recession risks that are really out there. So, guys, thank y'all for joining, and give me a like and a sub. You have a good one.